My name again, Aaron McDaniel. I am the CEO of Access Invest, which is a mobile aggregator of equity and debt crowdfunding deals, bringing deals from 300 disparate sources into one easy-to-use app with a Tinder-like interface. I also know a little bit about real estate crowdfunding, given that I used to run a real estate crowdfunding platform called Tycoon. Definitely went through the trenches with that. So we got a great panel, so I'll have everyone go and introduce themselves. We'll start here with Joel, and we'll go down the line, and then we'll get into some questions.
Hey, thanks for having me. Sydney, thanks for putting on a nice program. My name's Joel Block. I'm a 30-year veteran of the hedge fund and venture capital business. I spent 18 of those years in a venture capacity, and then have started a hedge fund, and we are buying distressed real estate assets all over the country, and recently have migrated a bunch of our money from Texas into the Midwest and so forth. But because all of my friends are syndicators and fund managers, several of us have gotten together, and we put together a new kind of a platform, which I'll describe maybe later on today, but I think that it's going to really be the kind of platform that will drive adoption by the masses with professional management of the transactions. Thanks.
Hi, my name is Luis Perez de Leon. I'm a co-founder of Realty XE and Chief Strategy Officer. Just want to say again, Sydney, thank you for putting on a great conference. And Aaron, thanks for moderating. You know, I've been in the business in real estate for the past 20 years, serial entrepreneur primarily. Got my teeth on the tech business, founded a data center management, or what they call now cloud computing. Before it was just managing data centers. And now starting Realty XE, we primarily focus on real estate funding solutions, focusing on a full capital stack, primarily in what we call gap funding, where we look at companies and we ensure the completion of the project. So we look at an opportunity from A to Z, and for our investors, we make sure that that project gets completed. It's kind of our differentiator. And look forward to talking with you guys.
Hi, I'm Kim Lisa Taylor. I'm with the law firm of Syndication Lawyers. I'm partners with Jillian Sidoti. And I've been a corporate securities attorney since 2007, focusing specifically on the real estate securities industry. So I've written a number of different offering structures, have also been involved in a lot of private equity joint ventures with syndicates and Reg D offerings, and as well our firm does the Reg A offerings.
Hello, I'm David Dobkin. I'm with the ASMX. First off, thank you to Sydney. This is a great conference, and thank you for putting this on. The ASMX is the first dedicated investment bank for Regulation A+ securities. We've developed a program that starts from testing the waters, drafting, underwriting, all the way through to syndication, and then secondary market trading for Regulation A+ securities. Because real estate is one of the biggest components of Regulation A+ thus far, we are dealing with multiple real estate entities, and we put together a variety of structures in the real estate space, so that's what we're here to talk about today.
And my name's Matthew Sullivan. I'm from CrowdFunders.com. I'm originally from the UK. I'm sure none of you spotted that. Came over here. And that's how it all ended. Oh, sorry, you're okay. So thanks, guys. So I'm originally from the UK, came over here 18 months ago to set up CrowdVenture.com, which is a real estate crowdfunding platform, really hot on the heels of the changes in the Jobs Act. We're very excited about what's happening with Title III, and we're very keen to do everything we can to expand the business and expand outside of real estate into all of the other opportunities.
Great. Thank you, Matthew. Thank you, everyone. So I want to delve into a few meaty questions. So given these topics and what we want to cover, I don't know if there's a chance for everyone to answer every single question, but if you guys just pipe in and give your answers, and we can build from there. So first and foremost, what's your favorite type of real estate? No, I'm just kidding. So let's
profitable one.
Let's delve in and talk a little bit about credibility, right? So what we as a platform would be doing is asking investors to put down thousands of dollars. You know, a lot of platforms, as they start out, they may have a base of investors that they're already working with from their list, but what about that person who just hears about you through a conference, through an email of some kind, through an article, and all of a sudden, you know, you want to convince them to put thousands of dollars into the offerings that you're offering on your platform? You know, what does that look like? What, you know, when it comes to, and also when it comes to the issue of due diligence, now, how much of that do you take on? How much of that due diligence becomes part of that credibility you build?
You're talking about the platform.
Yeah, from
doing
a
that.
platform perspective, yeah.
You want me to go?
Go ahead.
All right. Well, first of all, for me personally, I've been in the fund business for most all my whole career. Although I started in the CPA business, I got into the real estate syndication business before I fell into a venture transaction in the early 1990s. So I've been doing this consecutively for a long time. I've been through the up markets and the down markets. And one of the things for me personally is, although I can't tell you that every single deal has gone just perfect, I've never had an investor lawsuit and I've never had a regulatory inquiry in 30 years because I've done the best I can to at least be fair with people. People understand up markets, down markets, interest rates change, catastrophes. What they don't understand is lying, cheating, and stealing. And so, you know, that's when you really get yourself into some big trouble. So number one, the group that we've put together for our platform, and we don't take outsiders. If somebody knocked on the door and said, hey, can we use your platform to try to raise some money, the answer would be no. The only people who can list on our platform are equity partners in our group, and the equity partners in our group must be sophisticated and experienced developers, operators, and syndicators. So the only people who are part of our group are people that bring the kind of track record that you're describing. They have a documented track record. They go through a criminal background check, credit check, and all sorts of other vetting. We're not about vetting the deal as much as we are about vetting the deal maker, because the truth is that a good deal is not the same in everybody's hands. There are some people who just know how to make stuff happen better than other people, and that's entirely what we're about, is about identifying who those people are. And those are the guys, and our group is already 35 professional deal makers. We're talking about full-time professional deal makers. This is what they do for a living. They're not working on the side, or they're not a mom and pop trying to flip a house one time. I mean, this is what they do. So I think those are all things that help investors to feel safe and secure, and at least that's kind of one step.
Okay.
I've got a different way of answering the question. It's how do you communicate that to your investor audience? Because if you're running an online platform, it's a very different way of speaking to your investors than it is if you use a traditional syndication method. So in other words, if I was sitting across the table from Joel and I would say, I'm an investor, how can you convince me that my investment is safe with you? He'll have a particular approach that he articulated just now. But I think the most important thing to consider is if you're running an online platform, you have to communicate with your audience in a way that people understand as they are online investors. So you have to, in the way that you market your platform, you have to speak a different language. It has to be the language of trust, and you have to use social networks and social media and a whole range of different media types to be able to establish the sort of trust that you need to be able to get people to transact online. And that's a different way of communicating than it is in the traditional syndication method. And that's the way that you differentiate the successful platforms from the unsuccessful platforms, because the successful platforms are able to speak to an audience and develop and foster trust when the unsuccessful platforms aren't able to.
Yeah, I want to offshoot off the communication piece. You know, real estate, as we all know, is about trust and transparency and disclosures, and being able to provide tools, which we do at Realty XC. Is we offer tools for our investors and sponsors, a platform to evaluate the potential investment and make sure that everyone understands that we're looking at the deal the same way, and that when we come to a conclusion on what we're going to invest, that everyone's on a shared or on the same level playing field, that they know we are using these metrics to evaluate that property, and that we are transparent in offering those tools to our investors.
We've taken a different approach to the ASMX. We are registered with FINRA and the SEC, so we have to underwrite, and we go through that entire process as you would a traditional IPO with all of the issuers. We're platform agnostic, so we actually provide the tools for any platform or any issuer to then be able to raise and then distribute that through the traditional broker-dealer networks. So at the end of the day, it's going to be your wealth manager who's making the phone call as you as an issuer if you were to come with us. And so that level of trust has been built with them, and it's the compliance officer at that person's firm who's looked at our underwriting and our vetting and have then deemed it officially capable of being sold by that representative.
From an attorney's perspective, I think one of the original questions was, how does somebody who's never done this before establish credibility? And we help a lot of first-time clients who have never, say, bought an apartment complex or anything like that, and they go on to do multiple deals and then eventually get to a point where they're setting up their own crowdfunding platform or doing a fund. And so if someone comes to us who's never had experience and says, I want to do a fund, our reply to them was, you can do it legally, but you're not going to be very successful raising the money because you have to show a proven track record. And if you don't have a track record yourself, then the best thing you can do to propel yourself forward is to partner with somebody who already does have a track record with that kind of asset class. And align yourselves with them, do some deals with them so that you can gain credibility and experience through them, and then you'll be able to go off and start doing your own deals, or maybe the two of you together can combine and do a fund.
Great, great. So now I want to look behind the curtain a little bit and how things, really operate and how things are set up in cases where things will go wrong, and maybe not necessarily in any of the platforms up here, but there are over 100 real estate crowdfunding platforms, and odds are things are going to go wrong. So when it comes to the assignment of liability and taking on that responsibility, maybe you don't want to talk about your platform in particular, but what do you think the right model is over time? How do you think that's going to play out? Because there's a certain role where a platform say, okay, we're doing this level of due diligence, but when you get down to the way the terms are and what an investor signs, is that platform really taking responsibility for that due diligence? When fingers are pointed, what is that going to look like?
Well, we ensure the completion of the project. So when we go in and with a relationship with our sponsor, in our paperwork and how we work with them, if they're not meeting the guidelines, then we have a fiduciary responsibility to go in and make sure that project gets completed. And so we have tools and metrics that measures that to ensure that the completion of the project gets done for our investor's sake.
We work with fund managers and real estate managers who have a track record. Simple as that.
Right. But what does the model look like? Do you as a platform, for example, take responsibility for that due diligence, or is that something the issuer is taking on?
We have to take responsibility as a broker-dealer.
Yeah.
So, yeah.
I mean, the real question is, how do you build a real estate crowdfunding platform and scale and take responsibility at the same time?
Right.
So how do you become? What we're trying to do is all the deals that we do are deals where they're pre-funded by us and our investors. So they're all our deals. So we're in control of everything. So if a deal looks like it's going to go sideways, we throw project managers at it and fix it, and it's no longer a problem. But the real issue is if you have platforms out there that have third-party sponsors on, where there's no control, how do they stop deals going sideways? And I think what some of the platforms do is they outsource to third parties. And the real question is, what's going to happen when some of these deals do go wrong? I think your question was much better. I'm not saying that my question is any better than yours, but the real question is, what happens when deals go wrong and these attempts to use third parties to cure the defaults, is that going to become a real issue for real estate crowdfunding or for crowdfunding generally? Because I don't think there is one particular model that has been tested yet.
Sure.
I kind of look at this like when you go to the store and you buy some ketchup and the ketchup doesn't taste good, you don't blame the store.
Yeah.
Now they may try and blame the crowdfunding platform, but that's kind of the reason that we've put a couple safeguards in place ourselves. And And we're all backed up by a broker-dealer too, so the broker-dealers have certain legal liability. There's objective due diligence, there's subjective due diligence, there's meetings with principals. I mean, there's a lot of things that happen, and there's a lot of safeguards. But step one is that we've aligned ourselves with the strongest sponsors in the community that all have track records, that all have backgrounds. We're not dealing with amateurs, we're not dealing with part-time people. I mean, that's step number one. You have to weed out the people who are the most likely to have failures. Number two, the only people who list on our platform are equity partners in the company. So every single person has a certain amount of equity in everybody else's deal in our particular case. So what that means is that all the partners know what's going on in everybody else's deal, and if somebody finds themselves in a problem, there's 30, 40, 50, or 100 other partners that potentially could step in and intermediate and help to address the problem. We have this enormous brain trust of people because it's in everyone's interest that everybody be successful. So those are a couple things that, that we're using to address it.
My comments on that is that crowdfunding is really just a way to advertise a securities offering. So the first step in having a securities offering posted on a crowdfunding platform, whether it's your own or a third party, is to actually go through the process of generating a private placement memorandum or a Reg A offering or whatever other disclosure document is required by the exemption that you're choosing that's allowing you to advertise. So the first place the issuer would have had to have gone before they even get to the crowdfunding platform is to a securities attorney to draft those documents. Crowdfunding platforms, I can't speak to all of them or all of the kind of due diligence that they do, but certainly if you're dealing with a licensed broker-dealer who's going to be promoting your offering, then they're going to have their own level of due diligence that they have to do according to their licensure. But if you're dealing with one of these platforms where you're paying them a fee and they're posting your deal, it's really more like a multiple listing service. The only additional service there is that they're pushing out your deal to their group of investors, but they're not necessarily taking on responsibility. And, in any securities offering, this is why we have disclosure documents. The whole point of the disclosure documents is to explain the risks of investing to the investors and that and what their obligation is to conduct their own due diligence before they make their investment decision. And in effect, the private placement offering or the disclosure document, effectively transfers the risk from even the issuer to the investor in the event that one of those things that they've described as a potential risk factor happens. Should the crowdfunding platforms be doing their own due diligence? Of course, they should, and that's why they're looking for people with track records so that they can look at that and see what kind of experience they've had in the past and whether or not that's going to hopefully translate into positive results in the future.
I think you're right that it's a multiple listing service like in real estate, but FINRA doesn't look at it that way.
I understand.
FINRA does not look at it like it's just like a bulletin board, like you put it up there and then you walk away. I mean, they do enforce a certain amount of responsibility on whoever the BDs that are behind it.
If it's a broker-dealer, but not all crowdfunding platforms are broker-dealers.
Right.
So that's what I was speaking about.
No, and you're right about that. I would tell everyone though that it is a big mistake not to run your money through a broker-dealer. I always tell people that the greatest concern in the world, money's dropping in from strangers. I mean, the way that I've always done it in my career, and I've raised tens of millions of dollars from accredited investors, is, I'm never more than one step away from somebody. I know a guy who introduced me to a friend. But here, all of a sudden, strangers are going to start dropping money in your account. And I can imagine, and I don't know if it's happened yet, 6 o'clock in the morning, there's going to be a knock on somebody's door. Federal agents are going to show up. And they're going to say, is somebody in your deal? Yeah, they are. Come with us. You're under arrest. He's on the terror watch list. He's a known felon. He's this or that. And so we want to stay away from those things and put that on the responsibility of people who know how to make those evaluations. Yeah. So, there are a lot of things. And we're actually adding even one more layer. And there's all the required checks that broker-dealers do, but we're adding even one more thing. And that is that we're background checking the investors for frivolous lawsuits. We want to know how many plaintiff side lawsuits these people have been in. And have been in more than one or two, they're not welcome in our deals. Because those are the people that are going to really screw it up for everybody. So we're very concerned about people making a mess. Now, if somebody did something bad, that's one thing. But there are lots of frivolous things that happen, and we just are concerned that we are very careful to stay away from those kinds of people.
Just in quick follow-up to Joel's comment, I completely concur that any offering that's going to be advertised to strangers should absolutely be running through a broker-dealer. So somebody is doing anti-money laundering checks, bad actor checks on the issuer, and the accredited investor verification. The money's going into an escrow account and is being vetted through a broker-dealer. Because not doing that in an advertised offering to strangers is just putting yourself at huge risk, like Joel said.
Great. Let's talk a little bit about Title III. So how do you see Title III changing the real estate crowdfunding landscape?
I think it's going to be, it depends on which platform you're at. Right now, the real estate crowdfunding platforms, there's hundreds of them, and there are in different sizes and shapes, right? From high-end commercial to mid-size to residential fix and flips. And so I believe if you're at the lower end of that spectrum, that Title III is going to be able to help or attract some of those investors. And real estate is really, at the end of the day, a local investment, right? Real estate is local. And so if you could get local people working within your deals and working within your real estate fund, then you're going to get a local group and following, and you start building on those relationships. And so I think there's going to be a need for, or there will be people who are going to be able to use Title III. Certain platforms will be able to provide that, and we'll be able to, I think, see a benefit from it.
Yeah, I would concur. I really think this is a community-based tool at the end of the day at the $1 million and below level. So this is where a group of people are going to get together. Think of like a Boy Scouts club, and they want to build a building or something like that. They would use the regulation under Title III.
I think the $1 million cap is a real problem for real estate. Right. Because I think it means it's not ideally suited to real estate transactions, because if you have a real estate transaction below $1 million, then all of the costs associated with that transaction means that there's a lot less money to pay it back to your investors. So I think that Title III is much more suited to equity raising and to fund startup companies. And I don't think it's as useful or as appropriate as a regulatory mechanism than something like Title II or Title IV, which is Regulation A+.
I personally am not as enthusiastic about Title III as a lot of other people who are here in this room. I was at first, and I think that for venture transactions, for seed money, fantastic. I think potentially for some like a local boys, like you said, a Boy Scout little building or something, fantastic. But I have great concern about dealing with non-accredited investors. And maybe it's because I've mostly dealt with accrediteds for my whole career, but non-accredited investors are the investors that have misunderstandings. They didn't really understand how it worked. They didn't have an attorney to call. They don't really understand the documents that Kim's firm writes because they're very complicated. They don't understand the tax ramifications of how these transactions work. And I could just imagine a truck driver gets his W-2 on January 30th, and on February 1st he files so he can get his tax return refund real fast. Well, that's the way it works for everybody, for 95% of Americans. But, all of a sudden now they're going to start getting K-1s on April 1st, and they don't understand why they got to wait 3 extra months to get their paperwork. And then so they file it without the K-1. Then they get a letter from the IRS. I imagine there's going to be all kinds of problems. And maybe some of this will be dealt with through education, but I personally am not that excited about dealing with non-accrediteds myself.
And I think that those of us who are playing in the space are trying to mitigate that, specifically by having the issuers be very active in terms of their communication, especially with stuff like K-1s.
Yeah, I don't know if it's really possible, because this is a very complicated business. It just is complicated. And there's an awful lot for those people to learn to be successful. And I'm not saying that they don't deserve to be successful and that they shouldn't be educated. They should. But personally, I just know of all the investors that I've ever had, the ones that have less are the ones that have more problems.
I think that it works for the people who attend real estate investment association meetings. Anybody familiar with that? Yeah, you can go anywhere in the country once a month and go to any number of probably tens of thousands of real estate investment association meetings where people are networking and learning about different real estate strategies. Many of those people are doing single-family fix and flips or single-family buy and holds. And most of them are using other people's money, and most of them are doing it illegally. I could go to any real estate investment association meeting anywhere in the country, anytime, and find somebody breaking securities laws.
Every day.
Every day.
Every day.
And I talk to those people on a regular basis because they call and they ask our firm, what does this mean? And they come to our events and we teach them what's a security. And they go away thinking that it doesn't apply to them because they're just small people, and so they haven't been caught yet is what it is. And so, maybe it's going to help those people because it'll be a lower cost product, perhaps. Maybe it'll be a little lower entry level for them than a full-blown private placement memorandum, but they absolutely should be doing something. So that will be our role as attorneys to educate that class of people, if we want them as clients, that they really need to at least do the Title III in order to protect themselves and their investors.
I think Jillian talked about in the last couple panels about there are some smart non-accredited investors, and there is a group of people out there who could take advantage and are smart, and as long as the platform does their due diligence and vets those people and bring them into the fold, I think you can have a successful Title III program.
Sophisticated, non-accredited investors.
Oh,
right?
excuse me, sophisticated.
Well, they're called sophisticated.
Yes.
So, and I think a lot of the comments that were made were more generic just to the concept of non-accredited investors investing in crowdfunded deals. But I want to dig a little deeper along the lines of, Kim, what you were saying, of something real estate specific. So the companies, the platforms, the types of properties that we see will take advantage of Title III. Is it more residential, fix and flip along those lines? Is it? Give me a little bit more of your guys' perspective from that side of it, not just a general baseline intelligence level of non-accredited investors.
Well, I think it's the only thing it works for because everything else is too expensive.
Well, but I thought you can't do a fund in Title III, right?
No.
You have to identify the property.
Right, you have to identify the property. So, fix and flip, that means you buy a
You have to
house,
do it again and
you do it,
again.
you liquidate the thing, and you got to start over again. So you're going to have very, very high entry and exit costs. And I heard Jillian say something else this morning. I wanted to ask you this. She said you don't have to have an SPV in a Title III.
Can't, no.
I didn't understand so is there some kind of
I'm not
different?
sure what she was talking about.
I'm not sure either.
So the SPV is being used to basically slam all shareholders into one shareholding. Yeah.
Yeah, so it's one line item on the cap
You
table.
can't put
was
them
the
all in one
reference.
bucket and let them into one investment group. They have to be independent.
Oh, I see.
Yeah.
Is Jillian in the room? Jillian.
She meant that you can't use an investment
You
company.
can't,
So they have to invest direct, is what you're saying. The realty mogul model doesn't work for Title III. Right, is that what it is?
Well, in the situation Jillian was talking about, when you have 6,500 investors, you can't use an SPV for any kind of crowdfunding deal because it becomes a regulated investment company and it's far too expensive. So the comment really wasn't just about Title III.
Yeah, this gentleman over here. Cannot use SPVs in Title III, period.
So what that means is on your cap table, you've got, if you've got 100 investors with $5,000 each, you've got suddenly 100 people turning up that each own a piece of your fix and flip in I don't know, Newport Beach or something. So I just don't think that Title III is appropriate for real estate transactions.
I don't think so either, mostly. It's good for seed money for venture. Get that first couple $100,000. I think that's going to be fantastic. Very hard to understand how it's going to work for real estate.
I think Reg A is going to be where the real estate ones
Yeah.
shake out.
Yeah.
Listen, maybe you can answer this, because Reg A Plus seems like it's very slow, and real estate moves pretty fast. I mean, so I don't really see, unless it's a fund and you have a long horizon.
Yeah, I mean, I think one thing to keep in
It'd
mind
have to
is
be a
the initial law was jumpstart our business startups, not jumpstart real estate projects, right? So it's, and as we talked about, right, a lot of the
Yeah, but
activity
that's
has
just
been real
interpretation,
estate,
though.
but- Right. Go ahead. What? Yeah. Comment or question or?
We're submitting language
Yeah.
to the Senate. for the bill that they're going to drop in the Senate for the real estate investors, because for that very exact reason, obviously the language did not contemplate a real estate transaction. And so we said we have 35,000 real estate investors who primarily, our organization is small real estate investors, flippers. And so we need to add this language to it, and they were very open to it. And they said, that sounds great. Please deliver the language to us, and we will include it in the bill.
Yep.
Because that's exactly who the bill fits best, is the small mom and pops.
And that was Scott Whaley,
Yeah, thank you,
president
Scott.
of National RIA.
Yep. Okay, so looking toward the future a little bit more, I want to talk a little bit about consolidation. So especially when you talk to a VC, when an industry gets disrupted, it's all about a winner-take-all opportunity, right? An Uber that's going to change transportation. That may make a little bit of sense for startups, but when you look at real estate, it's traditionally always been much more fragmented than other regions. So I wanted to see what everyone here's thoughts are of how it's going to play out in terms of consolidation. Because right now, as Luis, you had mentioned, there are over 100 of these platforms. You know, and then as David, as you had mentioned, there's a community element to it that maybe it's a little bit different than a nationwide business. So, go ahead.
So give you a little bit of background on, you know, I came out of 1995. Remember how many web development companies there were out there, right? Every corner had a web development company. It took at least 7 to 8 years, maybe 10 years to consolidate that group. I think we're seeing the same movie played again. And we're going to see hundreds of these types of platforms. That's just a drop in the bucket. It's going to get to thousands, and then you'll see, in my opinion, some consolidation. And it'll be then roll-ups, and there'll be companies rolling up other companies. But I still think it's still, if you walk out this street and knock on, like Richard was saying, people still don't know about crowdfunding. I mean, we're talking inside baseball here. We all know all the players in the industry. But when you walk out and talk to a regular realtor or talk to a regular mom and pop, they have no idea what crowdfunding is. So I think it's a little, in my opinion, premature to talk about consolidation so much, because I still think there's room to grow.
You know, I think that before there's consolidation, there's going to be a lot of failure. And not failure in the deals, failure of the platforms. They're very expensive to run. The business models are generally poor. Unless you're FINRA licensed, there's not really any money in these. I don't know how people make money at it. And so it doesn't seem like it's a great business model. So it seems like there's going to be a lot of failure. I mean, we heard somebody last night say that failure rate could be as high as 90% for if somebody just starts a platform and just starts to run it. So there may be 1 or 2 or 300, and most of them are probably going to evaporate all by themselves. That's my sense, and then some will combine.
I think that's the same with any startup, though. So if you look at any industry which is a disruptive, or any new industry, you have a stampede of people getting into the business, 90% of whom have no experience in running businesses anyway. If you look at crowdfunding, it's seen very much as a technical or a technology play, and we talk about where Silicon Valley meets Wall Street. But it's not really a technology play. It's a marketing play, and it's a regulatory play. So in other words, the change in the regulatory environment, together with the ease of transacting online, creates opportunities if you know how to market your business online. But if you don't know how to market your business online, it doesn't matter how good the technology is, it's not going to work. So it's inevitable that you get a high failure rate, and that's not specific to crowdfunding. It's something that you actually want to happen because you don't want the marketplace to be cluttered with companies that don't perform. And yes, there will naturally be consolidation, but I think we're not anywhere near that part in the cycle where we should be discussing consolidation, because we are 3 months away from the implementation of Title III, which could completely change the perception of crowdfunding or online syndication. So we really don't know. I think there was a great line from the film Social Network where Mark Zuckerberg's finance director, Mark Zuckerberg said, we don't want to sell advertising because we don't know what we've got yet. And I think we're still at that early stage where we don't know where this whole online investing, syndication, crowdfunding thing is going to play out. So I think we're years away from consolidation.
Yeah. So along those lines, given that there are and will continue to be so many platforms out there, how do you differentiate? or how does a platform differentiate?
I think that we're going to start to see some fragmentation. Just like the issuer doesn't buy all kinds of real estate. You know, when somebody comes to me and says, oh, I just want to, you know, I want to be able to invest in anything I want to do, and my direction to them is typically, you shouldn't be doing a kitchen sink offering because you won't be successful in raising funds for that. If you have something that you have experience doing and a track record with, then why don't you focus on that particular asset class? I foresee that this crowdfunding industry will maybe go into more of a niche-based asset class crowdfunding, where you might go to this site and look at all the mobile home park opportunities. You might go to this site and look at all the apartment opportunities, and it's kind of segregated in that way.
Yeah, and there's also going to be other structures. We're working in real estate, but we're also putting together mezzanine funds for real estate guys. So now they're able to actually put a structure in place that gives them more access to capital outside of traditional banks. So that we're taking a different approach and saying, all right, so people who invest in mezz debt or senior subordinated debt, we can design funds specific for that and just start churning those out. And making the companies that actually exist in certain areas. And I don't think that really has been explored yet, because everything is really new. We haven't done any of these real estate deals through Reg A yet. They're just coming. In 6 months to a year, we're going to have some track record with it. You're going to see where things shake out, where the returns are, and how these things start trading in the secondary market. Because that's really going to drive the next wave of valuations, and you're going to see an entire community actually come in and buy these securities afterwards, because we're creating new paper. And that's what's going on.
I think the way companies will differentiate themselves will not be through asset class or investment types. It will be in the way that they engage their investor customers. So the platforms that will be successful will be the ones that know how to speak the language of social media, how to engage the millennials, how to communicate to their investor networks. And they may have a very wide range of investment products. There may be specific products, but the information they provide, the way they communicate, the way they establish trust with their investor networks, they will be the successful platforms. And so it's not going to be about whether you are targeted on a particular asset class or a particular investment type.
Yeah, I think you're right with that. It's going to be the trust factor, and it's going to be working with your investment group and building that trust and providing them really transparency in the offering, and as you grow that relationship, you can grow your business. And so the differentiator is going to be how well you can communicate your value proposition and your trust factor, and how well you're letting your group peer into your business model and being very transparent.
Yeah, I kind of look at this a little differently. I kind of wonder if crowdfunding is always going to be about retail investors. I mean, I agree. I think that platforms are going to be like, marketplaces where opportunities are available. But when Richard Swart was talking this morning about, that the little moped, we're not going to be going real fast on a Ducati. It's going to be kind of like limping along for a while. What's going to make it really accelerate is, where the Wall Street people, the registered investment advisors, the broker-dealers, they want to provide their clients with some amount of exposure to real estate. And the options they have right now aren't very good. They've got they've got REITs, they've got a couple other things. But, for the most part, these public REITs, they all have market risk. And that's part of the problem with Reg A+. I mean, is that you start bringing on market risk. So not only now do you have startup risk, but you have market risk. And so it's a whole other complication. But that's a different discussion. But I think that a lot of these registered investment advisors would like to provide some of their clients with some exposure to real estate, especially if they can find high-quality sponsors and they have a place where they can go get those sponsors. And, this business could take off like crazy if you get more supermarkets on every corner for people to be able to buy stuff at. And, we're not talking about like just a handful of us up here or 200 little things that are going. I mean, in this giant economy, most of these people deal with advisors of some kinds. So we really have to engage the advisors, and that's the way that it's all going to take off. The advisors are the ones that are going to, kind of find that we like this. As much as I think that the communication is right, you still have to have something to communicate. I mean, listen, you have 100%, Matt's right. You got to communicate properly, but you also have to have something excellent to communicate and then, you know, you can hire agencies to help you to communicate those messages properly. But, you know, at the end of the day, people, you know, you don't want empty suits running these deals. You got to make sure that you're dealing with professional people that know what they're doing, that can take the heat when it gets uncomfortable.
Yeah, and the crowd isn't going to be always retail, right? I think we presume the crowd is retail, and it's not. It could be the crowd of institutions. It could be a crowd. There's going to be, the crowd is going to be splintering, and right now we think about the crowd as a retail crowd, but I think it's going to be a whole different type of crowd. You'll be institutional crowds that you're going to tap into. There'll be other regional crowds you'll be working with, and there will be a retail crowd. So the crowd's going to be there'll be different types of crowds out there to work with.
Yeah, and actually, if you look at a little bit of an older brother or sister to what we're talking about here, if you look at the lending marketplaces, even though the Prospers and lending clubs tout peer-to-peer lending, a majority of the money that is working in their marketplace are institutional investors. Yeah. So,
you know, we're seeing that. I'm glad you bring this up, because we're seeing the same thing. You know, a syndicator who needs to raise $2 million can't go to Wall Street and talk to a guy about a $2 million deal. They won't see him. Right. But they'll come to us, and this is starting to happen. Hey, Joel, listen, we'll place $50 million with you. We want you to help spread it across 20, 25 deals. And we're looking for apartments. We're looking, you know, I mean, they know what they want. They give you the criteria,
Yeah, and ultimately, crowd is different. It's not a retail crowd. It's a different crowd.
And what we call those institutional co-investors. Because they want to invest alongside the crowd. So, you know, you have the registered investment advisors, you have a retail crowd, you know, and then you have these institutional co-investors. So really the crowd is already, in just a couple of years, is starting to take shape in different places. And we're very clear, you got to have your own crowd. The platform to be successful has to have its own proprietary crowd. That's important. Yep. But it also needs to have a network of RIAs. It needs to have these institutions. And the more tools it can bring, the better sponsors it's going to attract. And I just will say that in order to get those things, you cannot have amateur promoters. They will not take part-time amateur promoters. They need full-time people who are committed to paying attention to what they're doing, that can pass through some due diligence, because they're not, you know, remember, these institutional co-investors are fiduciaries of other people's money. It's not that Dr. Smith doesn't care, but those guys are fiduciaries, and they have to look at everything.
One very quick point is that I think we're going to see many more aggregation platforms coming into the marketplace. So as you have growth in the number of real estate platforms offering diverse asset classes, we'll see more and more platforms that act as crawlers or spiders that actually work on behalf of institutions or retail clients that look through all the platforms and find the real estate transactions that match certain criteria.
Kind of like Access Invest.
Yeah, exactly.
That's what we're doing. So one more quick question before we have a couple questions from the audience. So, and Matthew, you had alluded to this a bit from where you stand. The platforms that are going to be successful at scaling out, you know, is it a tech approach? Is it the marketing approach, like Matthew you had said? Is it having more of the core real estate DNA? What is it that makes platforms, or as we go forward, is going to make the platforms successful to scale out?
Well, I would just say that you have to have, as your hygiene level, real estate DNA. You have to be able to transact in a real estate market and not be a technologist who's, you know, suddenly become a real estate expert by reading a book. So you have to have that background. But I think the critical thing in engaging an online customer base is the ability to communicate to that client base in a way that they understand. So that's, I'm just sort of reiterating. So I think that's what defines, if you look at the really successful platforms, the Patch of Land, Realty Shares, Realty Mogul, it's the amount of information and the way they communicate with their investor networks that separates them from the platforms that are not as successful.
I would actually push this onto the issuers. I think that eventually, right now, everyone's putting their effort into platforms, but it's going to be the same way it was 25 years ago, where you just had places and marketplaces where you could go and buy stuff. So
it's about the deal.
The deal is going to be the reason that's going to drive it, and the pipes are getting put in place, so it's not going to matter which platform you're on. You're going to get access to the deals.
I think it's going to be a continuing marketing effort for the platforms to find enough deal flow to keep investors coming back and to continually enhance and increase their databases. Because I've seen some investor fatigue in some of these crowdfunding platforms that, only have, 8 or 10,000 investors, and they've already pitched them 50 deals. Those guys are kind of like, okay, I've seen enough of those deals. I don't want to see those anymore, or they're investing in something else. So you've got to continually, that platform has to continually refresh that group of investors and to have enough deal flow to keep them coming back.
It's definitely all of the above, because you have to be able to market, you have to be able to have good deal flow, you have to be able to have the good analysis and have the DNA in real estate, and then you're going to have that quality people working with you. So it's all of the above if you're going to be successful, and it depends on who your market is and what crowd you're going after.
Well, I think Kim is right on the target where there has to be a wide assortment of activity, and that's the reason why we built this giant network of deal sponsors, professional deal sponsors that are all sharing one platform, because it'll be a very diverse marketplace. But I think one other thing that is very critical and I think is very problematic is that the business model of the platform has to work. And, our experience is that professional promoters don't have anywhere to go because the business models generally don't work for them. And, if you don't have a good business model, number one, you won't attract sponsors, but number two, you won't sustain yourself. And, I don't know what everybody else is doing here and how it all works, and you don't have to say it out loud, but that's one of the biggest problems is the business models are really, they're not mature and they're not sustaining. And I worry about that. I mean, that's kind of why I see so many of these platforms. Maybe it's partly they don't have deal flow, so there's fatigue. Maybe it's because they don't generate enough revenue. And some guys have been very creative. There's this one attorney that is a securities attorney, and I think he gets all the legal work for the stuff that goes on his platform. So, guys have every different way that they're trying to figure this out. I don't know how, that's not a very growable model. That's a lifestyle model where he can feed his family, but he can never make any money that way. And he can't ever sell the business because he's not going with it. Right. So, but a lot of guys have tried to figure out things. I don't think most of them are very sustainable. They're certainly not investable, where somebody, where like in a neighborhood like this would come along and say, you know what, we'll put some money up to make it happen. So.
No question,
Yep.
if I may.
Yep.
Just briefly, I have a question from you. What is your company do? You sold your company to some of these crowdfunding. Your company didn't fail. You had a real estate. So you were in the Shark Tank. Tell us just briefly about that. I wanted to ask you about this.
Yeah, so I had run a real estate crowdfunding platform called Tycoon, which was acquired at the end of last year by a consortium of other platforms that included Patch of Land. And it wasn't a wild, successful exit, but it was an opportunity to do what I'm doing now. I kind of realized that it was so hard to differentiate amongst over 100 other platforms. And it was very hard, given some internal things I was working with, to have some of the DNA around the quality deals. And so I took that opportunity to exit. Yeah.
That I can say that real estate crowdfunding, I know I have seen companies like Realty Mogul and other, and is merger of the fintech, which you are kind of you're a technology guy, and also real estate.
Yep.
So the people, and so far some of them failed. What I see, and you were, by the way, you did a good job in front of the audience in the Shark Tank, and so you did good, right? That was a very big. But what I've seen, the companies that they failed, that they have no business in the real estate. They're not in the real estate business.
Right.
So they just all of a sudden said putting the portal and but people like, Joel, and Louis and the companies that, they are like Matthew, they are in real estate, so it's not something new. So what is your commendation is about people that they're in fintech, merging, how does that work? They're not destined to fail, because after all, this is real estate business.
Ultimately, I agree with what David had said. I mean, it comes down to the quality of the deal. And because there are so many options out there, if your platform doesn't have those good deals, then that investor is going to go elsewhere.
Deals, and also you have to know real estate business, or
and that's
hedge
part of
fund
it.
managers, and real professional.
I think the technologist maybe didn't put as much credence behind the quality of the deal needed or some of that real estate DNA that's needed to be successful. It's not just create this technology platform, get a bunch of people to see deals. No matter what deals there are, they're going to fund. It really has to do with having unique deals that you're able to differentiate, that you're able to have an active funnel of it, a number of things that our esteemed panelists had said in terms of the quality of the
Jill,
deal.
you want to follow up on that?
You know, I just wanted to say, no, I mean, listen, everything's great. And by the way, I think that your situation on Shark Tank was one of the worst examples of Mark Cuban ever on the show. I mean, I think it was one of his, he was just, a lot, sometimes he gets like out of control, rude and mean, you know, which isn't very often, but he was, with you, he was stupid.
He was
I mean,
very
he was
mean,
just
yeah.
purely stupid. So,
Yeah.
but that's not my comment. You know, our firm has produced, you know, a fair amount of material. We've got a white paper on crowdfunding. We've got a little booklet, which is available in PDF, this little crowdfunding 2.0 little book that we wrote. And if you want a copy of these things, just come give me a business card, and we'll give you all these different resources that will help you, some fascinating materials. Educate yourselves on these things. Surround yourself by people like this. These are very cool people that know a lot. A lot of us, we know each other now for, what, 3 or 4 years? Some of us much longer than 3 or 4 years. But in this new environment, many of us have become very good friends over some years. And, you know, I hope you'll come and, you know, give me a business card, and we'll send out all the stuff that we have, and, you know, and keep educating yourselves. It's awesome.
Awesome. So we have time for one question from the audience. Yes.
You know, Joel, it's Kim, right?
Yes.
You know, I'm very concerned. I'm an issuer also, and I'm very concerned about the responsibility of an issuer. That is this regulation really going to pull us to be responsible again for what a BD might be responsible for, where the money's coming from? You know, I'm worried about, you know, that responsibility to security regulations for an issuer using this. Is it, you know, should I just become a BD? You know, when you try to use
You should not become a BD. No. You know, we can both take a piece of this, but it's not nearly as complicated as you think. It's very complicated, but you don't have to worry about all the details, because a lot of the details are being worked out by platforms and attorneys and other people. What you need to focus on is putting out good product and making sure that you are a good steward of whatever capital you raise. And, you know, and then make sure you're dealing with reputable people, reputable licensed attorneys, decent accountants, people that know what they're doing. You cannot possibly learn everything and be everything to be successful. You're going to have to build a team of people around you. You know, now you're in film, right? That's what you said. So totally different from real estate. The structures that you use to construct your deals are very different from real estate, largely because you don't have any liquidation value if something goes wrong, where real estate does have liquidation value. So everything about how you organize yourself is different. But I would make sure that you're surrounded by plenty of people who know what they're doing. Get yourself onto a good team.
And I agree, and I can do that on the issuer side. What I'm worried about is the non-accredits. And that's what I'm worried about is we've been advocating accredited investors, we've been able to our business model, consider using this regulation, and all of a sudden get, you know, non-accredited in, you know, how responsible is an issuer?
Yeah, I have another thing I'd like to say, but Kim, maybe you could address how much. I mean, if he takes in non-accredited money, I mean, are there some walls that protect issuers from non-accrediteds and all these new rules?
You know, no, there's nothing new here. It's just, you know, who do you want to deal with, right? None of us would have partners or even spouses if we didn't have to, right? Because you got to deal with other people, right?
Well, I don't speak for
so
yourself.
We deal with other people because they fulfill some need for us. If you have enough accredited investors to be able to, you know, to do your deals, then you wouldn't want to go into this space. There's no need.
Well, no, you know, it's not only about money, because the money, there are some non-accrediteds or some sophisticateds that have some money. They actually cumulatively have more money than everybody, but there are really great reasons to deal with non-accrediteds, especially in your business. Let's say you need $10 million. Go get $9 million from accrediteds and get $1 million from the non-accrediteds, and here's why. Because now you've got, let's say you take $5,000 from 200 people, or $2,000 from 500 people, or whatever. then you send out a little message. You say, listen, would you please tweet this to everybody? Would you please put this on LinkedIn to everybody? Put this on Facebook to everybody. You've got 500 soldiers who now are your partners that want you to succeed. None of us have that right now. I got a couple partners, you got a couple partners, but none of us can create a viral effect by ourselves. If you had, the one thing that excites me about Title III and Reg A Plus, about dealing with non-accredited, as much as I'm not used to it, the one thing that excites me about it, especially for a business like yours, where get the word of mouth out is really important. I mean, real estate doesn't matter that much, but in an operating business it does, especially yours, is you got this army of people that all of a sudden are your partners. They want you to be successful as much as you want to be successful. That's an awesome thing. So.
Well, but you have to vet the people. So, you're going to have to put your own systems, policies, and procedures in place to make sure that you want that person, because if they're, mentally unstable or they're just not a good fit, then you want to be able to kind of ferret that out.
Yeah, well,
Hey, what about the idea of having some kind of like an ejection button? No, is there such a thing?
Yeah. So,
disassociation.
Is there such a thing? Can you pull the button?
Yeah.
Oh, yeah. Oh, yeah.
Now, then we go, but if I may, so when we're going to go to the definition of a crowd. We have companies like our crowd. I mean, what the limit you will set if you want to bring the people. So you can have any kind of different
Aren't
definitions.
those guys?
of crowd.
Those are all accredited, all of them.
They are, but you talk.
Right, 6,500 investors, there's going to be an insane person. There shouldn't be an
Make sure you have a good disassociation clause in your.
The
We're
ejection
going
button.
to raise $100,000 or $200,000 or $1 million. There's crowdfunding platform, they do $1 million to get in.
But the thing is, if someone's going to give you $200 and be in your crowd, the risk to you is $200. It's a share price. So if someone like that and they're going to sue you or something like that, their risk is you're going to have to pay them $200 back. But if the guy's in for $25,000 or $50,000 or $100,000, you're going to check them. We have the tools in place, so when the money's coming in and you get a big number like that, you're going to call for the background check. You're going to call for all that stuff. So you're going to know the big guys who are coming in with the money. And then the secondary market trading, if one of these big guys is trading out of the system, then you're going to know about it before it happens.
Are you finding that it's common? Everybody inspects the issuer, but are you finding it common to inspect the investors? Because we are.
No, we're inspecting all big investors.
Yeah, so are we.
So if it's a number that's bigger than pocket change and going to the movies, we're looking at the person.
Yeah, so are we. I mean, and that's what we're doing, those plaintiff background checks and some other stuff on Lexus.
Thank you, Aaron.
Yeah.
Well, we have to go to the next panel. Thank you. I have to, Aaron, thank you.
yeah. Thanks, everyone. Thank you, Matthew, David, and Kim, and Luis, and Joel. Thank you, guys.